Welcome everyone. I'm John Conti. I'm the Acting Administrator of the Energy Information Administration. As most of you know, EIA is a statistical and analytical agency within the U.S. Department of Energy. By law, EIA's data, analyses, and forecasts are independent of approval by any other officer or employee of the United States government. The views expressed here today by EIA should not be construed as representing those of the Department of Energy or any other federal agency. EIA's vision is to help people understand energy. In that vein, we are here today to cast a spotlight on EIA's short-term oil production forecast. We believe one of the best ways to help users understand our short-term energy outlook is to be as transparent as possible about how we formulate our forecast. To inform and keep our analyses as sound as possible, we have a strong tradition of engaging with stakeholders to carefully consider their perspectives and the possible insights they may have to offer. We do this mostly through EIA's annual conference, but also by participating in other energy conferences and through working group meetings and workshops, of which this is one. Although we have not had formal workshops related to the STIA forecast in recent years, we like to begin to engage with our stakeholders on a more regular basis. This is the first step in the process. I would like to expressly thank the participants in this workshop today, especially the presenters who have given generously of their valuable time. Presenting for the Domestic Energy Producers Alliance, DEPA, is Hamm, Chairman of DEPA and Continental Resources. Presenting for Drillinginfo is Phillip Dunning, Manager of their consulting services. And from Rystad Energy, we have Artem Abramov, Vice President of Analysis. I look forward to a robust discussion that may help all parties to better understand and forecast short-term trends in the oil production.
So just a few housekeeping items here. If you have questions, as we mentioned previously, please use the chat button in WebEx and include both your name and company affiliation. That will be very helpful. We'll hold questions to the end. So my name is John Staub. I am the Director of Petroleum, Natural Gas, and Biofuels Analysis at EIA. Starting with a few key takeaways from our short-term energy outlook in November of this year. First off is that our projection for U.S. crude oil production is that the U.S. will reach 9.7 million barrels per day. We also expect that U.S. crude oil production will grow 336,000 barrels per day in the second half of 2017, which is almost identical to how much it grew in the first half of 2017. The Permian Basin and Permian Region is the key source of the growth that we're experiencing in the U.S. currently. During the first half of 2017, the Permian grew by 214,000 barrels a day, and we are forecasting it to grow by another 257,000 barrels a day in the second half of 2017. We think that hedging activity has likely increased with rising WTI prices in recent months, which is a key part of the market as it identifies most value for producing oil. And we also, from our analysis and talking with other participants and analysts, we see that the increased use of sand for hydraulic fracturing is increasing well productivity, but it also appears to be having impacts on the rate at which well completions are being achieved. Looking at our outlook for total U.S. crude oil production, we recently had a This Week in Petroleum article on this subject, and this is an updated slide. We see on the right-hand side the amounts of growth from first half to second half of 2017 for a number of key regions. As I said earlier, the Permian region is the largest area with 257,000 barrels a day of growth during this time period, followed by the combined Niobrara and Anadarko regions with 117,000 barrels a day. The Bakken is also growing. We have it growing at 31,000 barrels a day from first half to second half. We do see declines primarily in Alaska of 50,000 barrels a day, which has been the long-term trend in Alaska. and there's essentially the Gulf of Mexico and the Eagle Ford are flat across the forecast. This chart, a set of charts, shows what I just showed on the previous slide in more detail, and we see on the left-hand chart the values for December for 2017, 2016, and 2018 in terms of how much growth is occurring in the Permian. So we have growth from 2.1 million barrels a day in December of 2016 up to 2.6 million barrels a day in 2017, and then a little over 3 million barrels a day at the end of 2018. You can see the effect of Hurricane Harvey on the Eagle Ford on the purple line, and the Bakken with its small but steady growth in the beginning of the projection. On the right-hand chart, you see both the Niobrara and the Anadarko regions in terms of their growth as also being significant regions of growth. Areas outside of these regions, let's see, there's some comments about slide projections. I'll continue. So in terms of our forecast, there are a number of factors that we use for producing inputs. Just a second here. There we go. Thank you for the feedback, everyone. We appreciate our stakeholders and the feedback you provide us every day. So, all right. So in terms of our main factors that affect our short-term outlook and how they're incorporated, first is oil prices. And we could spend a whole day talking about oil prices and how oil prices are set in the global market as demand and from consumers and from supply from producers interacts. So we're not going to focus on that today, but oil prices are an input to our modeling, and we'll talk about them as we go through here. Secondly, rig counts are an important part of the forecast, as they are one of the most timely pieces of data because of Baker Hughes and other organizations gather rig counts on a regular basis and on a weekly basis. Also, with rig counts, we see a fairly tight correlation between movements in oil prices followed by changes in rig counts with about a 4-week delay. The 914 survey that EIA runs collects production from operators for both oil and gas, and that is our primary data source for historical monthly state-level production of oil and gas. We also use Drillinginfo for actual well-level data as they aggregate state administrative data, and that we use to estimate decline curves, initial production rates, and total volume that will be produced over the life of wells in different regions. We also have information from Frac Focus that we receive weekly that shows the rate of filings from operators, and we review quarterly reports, trade press, infrastructure reports, all of which are included in our modeling. In the next few slides here, we're going to look at the diagram that shows the flow of data. And so in these slides, the blue boxes represent data or information that goes into the analysis, starting with the 914 survey and the Drillinginfo well level data. We use that information to develop well level declines, and I'm sorry, the chat window needs to be moved. All right. So with these two data sources, we first are able to we aggregate all historical data for wells drilled before 2015 into cohorts of production data for 57 onshore regions in the U.S. We also use the data for producing vintages of production for those same 57 regions, but on a monthly basis for January of 2015 through August of 2017 as a set of historical wells. And you can see the wells in the small graphic here, the amount of production that's coming from wells in our analysis that were drilled before 2015. And as you add the next piece of analysis where we're doing more detail, we see that production also being augmented to the total U.S. production. We then also have, we look at historical rig counts and price forecasts, both recent prices and our forecasts going forward through the end of the forecast to develop our forecast of rigs going forward. And as I mentioned earlier, the count of rigs is important for determining how many wells are drilled going forward. There are several pieces of additional assumptions that we apply. We look at rig efficiencies from the drilling productivity report, as well as information about drilled but uncompleted wells and technology improvement. All of that combines together to form a forecast of new wells in terms of production by those 57 regions going forward for future months, so for September 2017 out through the end of the forecast, and that gives us new production. We also have a feedback mechanism where we look at cash flow to represent the impact that cash from production supports drilling activity and completion activity. So that the green boxes area provides this wedge of additional production from the latest historical point in time going forward. Shifting to the Permian, this is a similar graph, but just focused on the Permian region. We see in the dark blue region the production that's coming from wells drilled before 2015, followed by the medium blue section of production coming from wells drilled between January of 2015 and July of 2017, and then finally forecasting forward the new production. One thing to note here is that that section of new production from September of 2017 through December of 2018 will provide 1.7 million barrels a day of production in December of 2018. So the rate of decline of shale wells is steep at the beginning, and the addition of production fills in quickly from these new wells. In terms of looking at prices, as I mentioned, and the relationship with rigs, on the left-hand graphic we show the U.S. rig counts in brown, and on the right-hand side we show Permian Region rig counts and the forecasted rig counts on the right. The thing that's important to notice is that with the rebound in prices from the low in 2016, the Permian has captured a larger share of that those rigs, and so that's part of the reason why the Permian is growing strongly. Looking at frac-focused completion filings, we see that even though completion filings decreased from 2015 to 2016, as shown on the left, Permian production was growing in 2016 and has continued to grow into 2017 with a very minor average increase in completion filings. In analysis of average new well production, We see IP rates continuing to increase in the Permian. So that's another piece that's important for contributing to production going forward. This chart here shows on the black dotted line our forecast before we subtract out the impact of hurricanes. So we do the modeling without hurricanes to begin with, and then as we get historical hurricane outages from the Department of Interior, those are subtracted out, and we also forecast typical hurricane outages that are layered on there, which is the brown line. This is similar to the blue area chart I showed previously for the Permian, but for the whole U.S., and you see the growth, the contribution to new production in green from September through December of this year, supplying production in the U.S. And finally, we have here a set of slides that show EIA's forecast for U.S. total crude oil production in the November CO, as well as a number of other forecasters shown in blue, both for the production and then the WTI prices on the right-hand side. These graphs show how, going forward, there always is a tendency to have more differing views and uncertainty about the production, as well as prices. These forecasts weren't all collected on the same day, so that's part of some of the reason the historical numbers move around a bit. So with that, I'd like to I'm going to bring up Harold Hamm's slides here.
Thank you, John, for the opportunity to present for the Domestic Energy Producers Alliance, DEPA, today. DEPA is made up of 29 member organizations that include about 10 million royalty owners, 10,000 oil and gas companies, individuals, and service companies. All of these, most of these are in oil and gas associations, both state and national. We see this today as an opportunity for constructive dialogue to continue to appreciate all nuances of current market trends or behavior. And all these DEPA shareholders have been working with EIA for the past several years, and I'll recap that just briefly. Beginning back in June of 2012, when Artem Abramov came into EIA, he began to reach out to industry for insight at that time. And EIA then was underestimating the new energy renaissance and underreporting growth. We were able to help EIA understand the vast impact and significance that horizontal drilling was having on the U.S. resource plays and what it would mean for U.S. production in the future. At that point in time, it's very important to have EIA reflect the rapid sustainability of growth and the Bakken, for instance, to attract midstream companies to construct oil pipelines. We were having to rail our oil to markets. Adam and I were on the Financial Times Energy Panel in New York City, for instance, in May 2015, and that day he invited me to discuss exports at the EIA Energy Conference in D.C. the following month in June of 2015. And at that conference, I might remind everyone, I spoke about the energy renaissance and the move in the U.S. from scarcity to abundance and why we needed exports to alleviate a bottleneck in refining capacity and capability for light sweet crude in America. You see, exports was the first underestimated pinch point. Our light sweet crude oil that comes out of these resource plays could not be refined by U.S. refiners that had been transformed to handle heavy sour crude for the most part. So EIA forecasting is very important. It moves the market and it impacts our industry greatly. For instance, within 72 hours after the November 17th short-term energy outlook was released, EIA data was referenced by more than 155 analysts. Another 25 articles appeared in major media publications. So right or wrong, no other agency provides data with greater impact. So it's crucial for EIA to provide the most accurate energy supply and demand data possible, particularly during this new era of energy in America. So on slide 2 here, we see that we are in a new era of energy in America, and requires even more sophisticated methods of forecasting. For the first 40 years, you might note that basically the U.S. was in terminal decline, and in the last 10 years, we've been on an extreme uptick in growth, which was further complicated in the last 3 years by OPEC's maneuvering to oversupply the market. The market crashed, if you will, and in a result, and then shut down of most of the U.S. activity, and then eventually gradual restart. And as supply has dwindled, accuracy is critical, to the entire picture in the U.S. U.S. independence brought about this new U.S. role that we're in today. We gave the U.S. new reservoirs to work with, the tight source rocks themselves that have produced these tremendous basins that are so prolific today. Continental, in fact, was a pioneer in the Bakken, Scoop, and overpressured stack plugs. We have a long history with it. And here we are with slide 3. EIA is still overstating a 2017 exit rate forecast. The history with EIA on this matter, if you look for the first 8 months through August 2017, and you can see it was fairly flat, but that our first concern, DEPA's first concern, began in July of this year after the market responded to Libya and Nigeria bring on an unanticipated 400,000 barrels a day. We noticed that industry had flattened out due primarily to these lower prices, and activity was curtailed. Yet EIA was still forecasting large numbers and large 2017 exit rates. So we met with the EIA in August and appreciate their time and effort again in meeting with us and expressed these concerns to them. And EIA did cut back its 2017 exit rate in September from 9.82 million barrels to 9.69 million barrels, but the EIA still remains on the high side by about 220,000 barrels or more, we believe. Actual production from April to August was very flat, as you can see here, and the activity and level and drilling has continued its downward trajectory through much of November. On slide 4, this is the example I was talked about with Libya and Nigeria and the impact of that 400,000 barrel unanticipated oil that came on the market as disruptions in those countries either ceased or slowed. And this drove down, this 400,000 barrels, drove down prices by $10 a barrel from $53, as you can see, in April to about $43 in June. So for about $10 or 20% in that period of time. And that 400,000 barrel amount is roughly equal to the original forecast of the EIA through year-end 2017 that we believe they're optimistic. So on slide 5, as you can see, U.S. activity did slow from June to November this year, and recently picking up only 9 rigs last week, finally, after 12 weeks of continuous decline that we've seen. So we went out to the public reporting companies in the second quarter to determine if what we were seeing was correct or not. And when we did that, we found that overall production was down 0.78% of those public companies that were reporting. And in the third quarter, we saw much of the same, down about 0.5% in production. These companies make up roughly 75% of U.S. production. So on slide 8, we believe that this unrealistic growth projection that EIA has made disadvantages U.S. market. So it's much like lack of export capability disadvantage the U.S. market. We're used to that. We saw $25 a barrel at that time in the U.S. Discount that came about as due to the refining capacity being limited. And unrealistic growth expectation is doing much of the same. Brent trades at a premium to WTI and at about 10%. This 10% advantage that puts America last, not first. And that 10% can mean the margin of profit or loss for many of the wells in America and many DEPA members. Slide 9 is just an example of what this has cost, as forecast costs U.S. in 2017. We calculate $4 billion in revenue, royalty, and tax dollars. Slide 10, we believe that the EIA must be responsive to all these changing dynamics and do it on a timely basis. EIA must be responsive because of this new era. For example, Continental is talking to investors, and we could grow our production 15 to 20%, but we have investors asking why. They want return on investment. Oil and gas operators are required by those shareholders or investors to be disciplined in their approach to development. So the capital markets have changed. Shareholders want return on capital employed, and growth at any cost, and even growth within cash flow neutral no longer applies. They rightly are demanding decent returns. Slide 11, U.S. production growth has moderated. We only have 45 days left in 2017, and it's become mathematically difficult, if not impossible, to match EIA projections at this point. The average actual growth rate going back as far as September 2016 has been about 59,000 barrels a day month over month. It would take 130,000 barrels a day month over month projected growth rate to match those numbers today. Slide 12, let's talk about the Permian growth and EIA's drilling productivity report. Obviously, it is the largest growth area in America is the Permian Basin. The actual average Permian month over month growth up to August, where actuals last actual data we had was 40,400 barrels a day. Forecasting average month over month growth is 59,600. We think it's a uphill battle to get there. Slide 13, well performance projections are overstated, and we think some growth productivity gain expectation led financial analysts and industry forecasters astray this year. Many expected on a well-to-well basis that we would continue 2014, 15, 16 efficiency gains and productivity gains of up to 120% per well per year. Yet as we drill longer laterals and as the plays have matured, new well productivity has actually declined inside these density applications. One particular situation is the parent-to-child infill wells drilled within drilling spacing units. The parent wells, went unnoticed perhaps, was the parent wells were unbounded. And once they are bounded, instead of going up and increasing production much at 20%, we're seeing the plays actually decline, or the well productivity decline by 15 to 20%. We see the Bakken is one of the only plays that this isn't happening in, and perhaps we're not up to the optimization level yet for that to occur in the Bakken. And the market is taking notice of these discrepancies as much as other people like ourselves are. The market, in this example by Bloomberg, has said that looking back, the weekly data have tended to run ahead of the monthly, both as production drops and then as it recovers, and they're saying the same thing. How do you catch up here at the end of the year? So slide 15, key points we think to integrate and forecast moving forward is the fact that U.S. production growth has moderated due to price interference, and as you suggested earlier, prices makes all the difference. And performance projections are overstated across industry, and some efficiencies are peaking. Less sand is being used in a lot of areas now, and we're seeing once laterals are being drilled out to 2 miles, and of course a lot of them have been drilled out in some places for the last 10 years, but some efficiencies are peaking as we go forward, particularly with the increased density wells. And market pinch points are occurring. We mentioned, and those limit production. Remember distinctly the refining shortage for sweet crude that occurred early on. And then it's critical for crude oil and gas pipelines and infrastructure to be built out. For instance, today in the Permian, which tends to be getting a little gassier, there's only 4 BCF a day of takeaway capacity. There's going to have to be a lot of natural gas pipelines, crude oil pipelines, and water handling infrastructure put in the next few years. So shareholders are demanding also return on investment, and there's no longer growth at any cost. So hopefully these items will allow EIA to take a more realistic stance versus optimistic with regard to U.S. production growth forecast. And we thank you very much.
Thank you, Mr. Hamm. I'll now switch slides here to Phillip Dunning from Drillinginfo. Phillip, are you able to unmute your phone?
All right, you able to hear me?
We are.
Go ahead. All right, awesome. All right, well, I would first apologize for any excessive noise you guys hear inside the background, but if you can go ahead and advance the executive summary slide, I will start from there. So I'd like to thank first Mr. Hamm for his comments and expertise. As one of the forefront minds in oil and gas, and the work especially he's doing with DEPA on behalf of the producers, the owners, and many others inside the industry. It's a big undertaking. I'm going to take things a little bit differently, looking at the why. That's really the big question and the answer that we always try to answer. First thing we're really going to look at is the chicken or the egg. Now, this is looking just at the well level. So if you think about it, we always have well constraints, and then we also have pipeline constraints and water hauling and everything else. So what we're looking at really is that we think that most of the wells that are being drilled are in the money. But we think that there's going to be a bottleneck at some point in time, not to mean the sky is falling, but just an issue, especially with millennials that don't really want to enter the industry, many left in the downturn. There's just an overall recruiting issue, and it can impact abilities at some point. There's only so many veteran crews, there's only so many people out there, and there's only so much horsepower we can add without having veteran crews. And there's also trucking, right, that is also having an issue with recruiting, with drivers, and that's obviously how we get materials, and then there's always the possibility of having rail constraints at some point in time. So all these things can kind of build up into a bottleneck, and that's kind of what we've been looking at, especially with completions. The second thing is just really, why has production changed over time? Is this due to lateral length? Is it, proppant intensity? Are we finally dialing in on completions? Just what is it? And then we really take a look at the geology. Not everything is created equal. Your position is not always going to be contiguous. In most basins, things change. We'll kind of look at why. Go ahead and advance the next slide. And the next slide. All right, so right now we're just taking a very objective view of the Permian over time. It can just be seen that we've had a large increase in the overall number of wells that have been drilled, which is the blue. Completions are in red, so you can just see on average, they're just not overall keeping up with drilling, as we know. The overall increase in terms of DUCs over time, but you can only see that there's dips at the end of each quarter, and that's mostly when companies complete wells, and also with data lags. When it comes in, it always generally comes in around the end of the quarter. So you can kind of see how we build up, and then we drop down, and we build up again just over time. And lately, we've kind of leveled out, kind of into this rhythm, but you'll still see how it increases over time. Now, the whole DUC issue can always be due to infrastructure. It can be due to gathering lines, trying to do zipper fracs, which obviously takes a lot more people on site, parent-child completion issues. There's a number of things that can create that. And we think that there's a lot of questions and conversation around what is a sustainable level of DUCs. And you can look at it in a few ways. So, basically, we again think that all the wells that are really being drilled are in the money, so it's not really an issue at that. But we really do think about that it's a little bit differently. So if you pull out some of the less quantifiable points we were talking about, shortage of completions, expertise, supply demand issues on transportation, all of that can really affect whether or not these wells are being completed, and we really think that supply chain management is kind of the biggest issue that a lot of smaller companies are having. So see a lot of successful big companies that have really good supply chain management. They're able to get sand to the site. They're able to either store it or carry it. They're not having issues with water hauling, which can be very, very expensive if you have to truck on a per barrel basis. So all of this stuff is kind of leading into that supply chain management, which never used to be an issue, really before we started completing these really large pads. And then you also see a lot of emerging technology coming inside that industry, which will hopefully help things like blockchain and other types of tech. Next slide, please. So this slide just highlights the number of completions over time, very, very steady, even as we have increased the horsepower inside the market. And obviously there's a lot of markets out there, not just, but we've definitely been seeing a lot of people entering inside the Permian. So you'll see there's a lot more drivers than just that. Knowledge and team capabilities is extremely important as a factor. We've heard a number of operators say that, they've gotten a lot of new crews and they've had issues with them, so they're willing to wait to really get the crews that they know can do the job. And then there's also a ramp-up issue, right, and there's more pressure on those teams, especially locking them into contracts. And then zipper fracs, as we start to downspace wells, can also put a lot of pressure on those schedules because it takes 2 to 3 times the amount of horsepower, personnel, again, sand on facility, all that kind of stuff out there. And then in other basins, we've seen that you basically have to complete 2 formations at once, right? So you have to complete the Devonian and the Marcellus, for instance, in some parts of PA, or otherwise you basically lose pressure. And so again, having that much more horsepower on site in order to complete can just continuously create issues down the line. Now, obviously, you're completing more wells at once, but it just creates an overall lag, which can just create issues. Now, basically, before the last downturn, we saw a lot of companies basically building out their own completion crews internally, and we're starting to see that kind of pop back up again. So companies are basically just saying, we're just going to do it ourselves. We'll train them up. Basically, if they're not fully contracted out internally, then we can contract them out separately. And so, they're starting to get back kind of into that business model, which definitely makes a lot of sense. Next slide. Next slide is just an example of just another basin. So this is just the Appalachian Basin over time. You'll basically see we had a big drop-off in the number of wells being drilled, but also the number of completions has gone up sustainably. And so they've kind of leveled out, and the overall sense of DUCs that are out there versus wells being completed. Now, you'll see there's a big jump at the end of every quarter. That's mostly just because the reporting is quarterly in a lot of those states, so that just creates an issue with it. But also remember that there's a lot of midstream that's been coming online, and so basically if you had contracted out, let's say to put 300 a day through there, you either have to buy it out on the open market, or you have to complete your wells in order to meet that throughput capacity. So we definitely see a lot more increase of wells being completed just to meet that overall throughput capacity. Next slide. Next slide is just the rig movements across the Permian. So we're really just looking at interesting trends we've seen through it from 14 to 16 and 16 to current. Notice in 14 to 16, a lot of it was in the Midland Basin. You definitely see basically rigs all over the place. Most of them were kind of in that 1,000 horsepower plus, but you can obviously see that most of it was kind of focused inside the Midland Basin. Look in 2016 to current, and you'll notice that a lot of it is inside the northern Delaware, as well as kind of the southern Midland Basin, and then quite a bit up in Howard. And then there's also been quite a few lower horsepower rigs have been coming on the market. Now, the lower horsepower rigs, we generally see sputter rigs that are out there, not so much vertical wells anymore, but sputter rigs. And generally, as we see sputter rigs coming back on the market, it means that we're trying to get ahead of something. And so as we see those continuously popping up, it obviously means that we will see more and more wells being drilled. So trying to track, in a sense, where we are seeing those is an important metric that we kind of ignore sometimes because a lot of people just think it's for vertical wells. Next slide. And next slide. Yep. So we will look at the Delaware vintage decline curves, and we'll kind of go from there. And so what we really like to see is that over time, again, this is looking at an overall portfolio aggregate of the last 3 years of wells being drilled. We really do like to see an increase in the overall IPs, and that the decline rates basically maintain or are steady. And the reason we want to see that is that basically the higher the IP, and as long as declines are steadying out, we get a higher EURs over time. It's generally a little bit concerning if we have high IPs and the decline rates are getting faster, because we're really just kind of front-loading production at that point in time, and people are probably just putting it on an ESP just to pull production forward for higher returns. Now, the other thing to remember is that as these plays are a lot younger, a lot of downspacing has not been done yet. So basically, as we continue to drill either 1, 2, maybe 3 wells, a pad at a time, we will still see that increase in production. As we start to downspace with those child wells, we'll probably see the productivity kind of decrease again. But at least over the last couple of years, we've at least seen double-digit increase over time. And again, this is kind of on a 6-to-1 ratio. The next slide is taking into account just wells that are 7,000 plus foot per interval, so stimulated length. And what you should notice here is that basically we jumped up the overall peak rates by about 250 BOE a day just by adding in basically that constraint on it. And you'll see that the overall decline curves, again, are actually a lot shallower than they are on most of the other wells. And again, you'll see where they're located all across the basin. So we are seeing improvements year over year in terms of longer perf intervals, and we're obviously seeing better overall production coming from those. Next slide. So this is just looking at the perf intervals over time. Again, there's been a lot of talks about people doing 8,000-10,000 foot laterals, which take that into account with a perf interval will be very, very close. And all I want to show you is that over time, really the median has not changed. So with all the wells being drilled, everything being tested, the median has stayed very, very similar, around that 5,700 foot perf interval. Now, what you should notice is that the upper quartile, at least in the last year, is being skewed very, very high up. So basically, we're starting to see that upper quartile really expand into that 6,000 foot plus perf interval, where basically back in time we didn't see that. Everything was just kind of dialed in. So it looks like there's a lot less testing, a lot more people that it's just going to become their standard. And then you'll see kind of the big jump inside Q3 of 2017 to where the overall perf interval median has jumped up substantially. Next slide. Proppant intensity over time. So proppant intensity over time is generally a big conversation with people. It's just how much are we putting down whole, at least on that per foot basis. And all this is trying to show is that we have basically tripled what we've done since 2013. Now, the basin really, it's kind of come its own in the sense that it's pushing on average around that 2,000 pounds per foot or more. Most basins we see around 1,500 pounds per foot as a median, but we're definitely starting to see people push more. Now, this could be because we're targeting different formations. So again, a sand versus carbonate versus shale, they all treat differently. And so depending on what we're focusing on can obviously change what we're dialing in on. But at least over the last couple of years, we've just seen a steady increase, and it's basically kind of leveled out in the last couple of quarters. But again, you can just kind of see how the data's changed over time. Next slide. Midland Basin is a little bit different. So as we see, the Midland Basin has improved substantially from 14 to 15, and 15 to 16 is on par with what we've seen in Delaware. So very, very similar. Not really much difference there. The peak rates are a little bit lower, but again, it's not as gassy in terms of what people have been completing lately. So, we kind of expect those peak rates to be a little bit lower. Next slide. So the perf intervals, again, over 7,000 feet, what you'll see is that, again, there's a jump up here. The difference is it's not as big of a jump up, and I'll kind of explain why inside the next slide. But again, you'll see that we have had year-over-year improvements, and you'll notice that most of the wells on the map, is basically the same map as the last time. So the actual perf intervals that we're seeing inside the basin are quite a bit higher. Go to the next slide. So that's what this next slide is showing. So the perf intervals over time, the median has stayed almost about the same, but notice that it's longer. So the median's always been around 7,000 feet compared to the Delaware, which was a lot smaller. And basically, the Midland just doesn't have to grow as much in the sense of the perf interval because they've always been kind of at that higher margin. Now, people have talked about why. I mean, we've heard people say that it's because of older leases inside the Delaware that basically they can't drill longer laterals, or otherwise they have to renegotiate the leases, which puts them at a higher royalty rate. There's a number of reasons why, but again, just the difference between the two basins is that the Midland has kind of always been around that 7,000 foot plus mark. The Delaware's just starting to come into that in the sense of an upper quartile and not just random outliers inside the data. Next slide. So next slide just shows the profit intensity over time in Midland. It's very, very similar. So where the Delaware had to step up 3 times over the course of time, the Midland had already started at around 1,100 pounds per foot and has really just kind of held in and around that, between 1,500 to 2,000 pounds per foot. So it's kind of leveled off over time, but its step up hasn't been as great. So it's not a 3x step up. It's only approximately 80-90% step up. But also notice that compared to the Delaware, which didn't have a lot of outlier data points, instead the Midland, we are definitely seeing a lot more outliers. So we're expecting to see kind of upper quartile get skewed inside the next couple quarters, definitely above kind of that 2,500 to 3,000 pounds per foot mark. Next slide. So geology stack up. So this is kind of the big one that we focus on, and again, I'll kind of explain why to the next couple slides. So this first slide you're seeing here is that, for us, it's proving zones, it's proving valuation. So in stacked plays, the number one issue we have is Mississippian trend area. Not the most descriptive thing in the world. It's 4,000 feet of rock. It's kind of a thanks for not telling me very much about it. So, what we really have honed in on is exactly what bench we're producing out of. And so all this is trying to show here is an acreage position inside the northern Delaware compared to the formations that we're seeing around it. And the reason why I'm calling it out here is because I'm trying to determine, basically to the north, south, east, and west of this position, how many formations have been proved up or at least been tested, because it's a pretty good indicator that, if I have it all around me, law of similarity, it should be on my position as well, but at least it's also helping me to prove up the idea of, what I can book or, maybe possibly, what to drill next based upon that, kind of those offsets that we're seeing. And so this is all we're trying to show here. So basically the Bone Springs inside the north, generally the Wolf Camp kind of inside the main part of the position. But then towards the south, we've also been seeing some Bone Springs pop in. And again, understanding that and knowing exactly which ones are being tested is important. Are you testing the sands, the carbonates, the shales? I mean, what is it? Because again, as you start looking at completion techniques, it's going to change everything for you and can obviously change kind of the forward forecast maybe that you're trying to have on sand volumes, on water volumes, on a number of different things just because everything treats differently. So that's really our big thing, is proving those zones. And to go to the next slide, it's a good example of basically why that matters to us. And again, looking at the same position and then looking at the total thickness of the hydrocarbon column here, so basically Bone Springs 2 Wolf Camp, what's interesting is that even though, we were testing a lot of Bone Springs stuff up towards the north, what you see is that in the southern part of the position, it's actually the thickest part of what we have in that total column. And so again, understanding that from north, south, east, and west can really give you a clear indication of what parts of your field are viable for what formations, Is there a possibility that maybe instead of 8 wells per section, we can go up to 16 wells per section inside of a specific zone because it's an additional 300 to 500 feet thick? And again, taking all these into account can really factor into your overall production going forward. And we feel like a lot of people sometimes overlook it. Maybe it's because they don't have the expertise or it's just the time. But again, that's really what we've been trying to hone in on is exactly where are things viable and where are they not. And the next slide is one of the better examples we have. And this is, again, taking you to a different basin if you look inside the Mid-Con. But all you're going to notice here is that on this regional cross-section from the stack to the scoop, notice how the Woodford thins and then thickens again as we move north to south. Again, it's that high gamma ray or that white area. And then also notice how fast the Mississippian drops off as we move into the merge and into the scoop. So some of these formations go from 300 feet thick to under 100 feet thick very, very quickly. And that obviously will affect overall production, how many wells you can fit, all your predictions, on a per acre basis. And so again, we're trying to take this into account across the entire position because if somebody goes out there and says, I have 60,000 acres and I can fit 16 wells per section per zone, it's pretty easy to say maybe only on half your position that's really viable because you only have 100 feet of thickness across the other part of it. And so again, this is kind of the answers that we're trying to drive to as we look. And the next slide kind of gives an example of that. And this is basically just a cross-section across the merge. And again, all we're trying to show is that going from west to east, at least here, you'll see that there's about a 5,000-foot structural rise going into the shelf. And the reason why that matters is that the map of the upper right-hand corner is a position of an operator. And so again, if you think about that, if we have a 5,000-foot shift, and you're telling me that you can drill the same exact wells everywhere, we probably need to have a discussion on that because everything is changing as you're going from one direction to the other. And so really that entire position needs to be delineated in a couple different areas, to really understand. And again, we're not trying to, kind of talk against the companies, but we're really trying to get them to tell us, some more information on it. Again, this is just some of the stuff that we've been diving into as we look at doing these production forecasts, because again, they do make a pretty big difference, as you look at that going forward. And the last slide, again, it's just some takeaways that I was just talking about. So again, we think that geology plays a really important role, and it's sometimes ignored, again, for multiple reasons. Understanding the benches is extremely important inside these stacked basins, especially as we prove up validity. Type curves, by bench is extremely important. And then just knowing that all basins are not created equal, and so we like to look at them all individually. Overall, again, the production we are seeing increasing year over year. We don't think that will last forever, especially as we downspace and we start having that conductivity between wells, especially as we start to learn some of the parent-child relationships with it. And again, some of the basins just have a larger learning curve than others just because of how old they are. We saw that between the Delaware and the Midland just in terms of the proppant intensity. And then the overall perf intervals that we're seeing. So some step up faster, some are a little bit slower. So, and again, big thing is that drilling wells is only half the battle. Again, we think that having the dedication on completion side as well as the supply chain management is going to be a big thing going forward, and we're actually really excited to kind of see where that goes. So that's all I have.
Thank you, Philip. Now we'll have our team. I'll switch the slides here.
Okay, can you hear me?
I can.
Okay, great. So thank you, John. I think we have already heard a lot of interesting views and presentations today. So my presentation will be focused on the economic side of the story and primarily on the Permian Basin because essentially, there are a lot of quite strong projections about the U.S. oil and Permian Basin in particular production potential, but eventually it always comes down to the economic part of the story, whether it's actually commercial to drill new wells going forward in different price environments. So if you go to the next slide, first of all, I just would like to take a quick look at the historical evolution of the activity in the recent quarters and the production, which is shown as the orange line on this chart. So indeed, we observed that this steep growth in the activity, initially in the rig counts and the drilling activity, and then in the horizontal completions quarter by quarter, as you can see on this chart, brought a significant acceleration to the pace of production additions. So essentially, as of quarter 3, 2017, we have already surpassed, according to our latest representate 2.5 million barrels a day line, and we are talking about almost 500,000 barrels a day of year-over-year growth. And you can see on this chart that in fact the pace of monthly production additions have been accelerating a little bit in a very recent months after fairly modest pace of growth in 2016 and also 2015. So if you go to the next slide, I would like to take a closer look at these completions which actually drive in the production growth in the recent quarters. So first of all, we have already reached a very significant milestone already in quarter 2 2017 this year, when we were completing more horizontal wells per quarter than back at the peak in 2014, and in quarter 3 it increased even further. But it's also a very different type of wells which we are completing today compared to what it was back in 2013. So essentially, as you can see on this chart, activity really shifted from gassy Southern Midlands back in 2013 and some early Bone Spring activity in Delaware, New Mexico part of Delaware, towards Northern Midlands, towards the landing Wolfcamp and Lower Spraberry landing zones in Northern Midlands, and also Reeves and Culberson counties on Texas side of Delaware. So as of today, almost 65-70% of the wells, they're basically drilled in Northern Midlands and Delaware, Texas. And if you go to the next slide, then it's not only the shift towards different subplays, it's also, of course, a drastic change in the well configuration, typical completion intensity, which boosted all kind of completion indexes, which we are tracking closely at a completely new all-time high level. So already in early 2017, we were completing more lateral footage per quarter, completing more frac stages and pumping more proppant and water into the wells than back in 2014. And as of quarter 3, in fact, as completion activity increased further, together with the proppant demand per well, we are actually already pumping, to 120 to 130% more frac sands than back in 2014 in the Permian. So we're clearly talking about very tight situation when it comes to all the proppants and general logistics in the basin. And if you go to the next slide, I think from the economic perspective, there are two important questions which we would need to address: how economic the DUC inventory is and how economic new drilling is. There were quite a lot of discussions this year about this rapid build-up in the DUC inventory, particularly in the Permian Basin. I think what we observe right now is that most of this build-up was just natural. So it was just driven by natural luck between the recovery in the rig counts and the recovery in the completion. So there was actually a very limited contribution from the bottlenecks on the service industry side. So if you can see on the left chart here, in all core subplays, 85 to 96% of the current DUC inventory correspond to the wells which were drilled in this year. So essentially wells which were drilled in recent months and quarters, and most of them, they're just scheduled for completion in the near future. And if you look at the right chart, you also see that from the go-forward break-even price perspective, so if you just disregard drilling costs, and this is in fact how some E&Ps may think in the new fairly high service price environment as we move towards 2018, so essentially some of these DUCs can be evaluated as a completely new projects, ignoring the drilling cost part of the story. So everything that is green is actually commercial from the go-forward perspective in 50 USD per barrel environment. And in Delaware and also in Midlands, normally we're talking about 80 to 90% of the DUCs which are commercial. So as such, DUC inventory as a standalone topic is not really important. So if you go to the next slide. Earlier this year, we have done a research due to the rising concerns about actually the full cycle economics of the modern, very intensive shale activity in the Permian Basin, and we looked at something that we call decision break-even prices for top 30 operators in the Permian Basin, based on the number of horizontal completions in 2016 and 2017. So the decision break-even, in our view, it is the closest proxy to what operators should think about when they actually make decisions about drilling and completion of one marginal well. So we take into account drilling and completion costs, lease operating expenses, all kind of production taxes, royalties, transportation costs, and price differentials. And we use 10% discount rates in the calculation. So you can see that these decision break-evens, essentially, they are very much below 50 USD per barrel for majority of operators. So which means that from a marginal well perspective, majority of operators, they're able to realize at least 10% returns. and even those operators on the very right of this chart with not very favorable well economics, normally they would treat the activity in the Permian Basin as a very early test type of activity, and they expect quite significant movements to the left side of this chart. And if you go to the next slide, if you just restructure this picture a little bit and draw 40 and 50 USD per barrel lines, we will see that a lot of operators, from a marginal well perspective, they're able to realize very favorable returns even in 40 USD per barrel price environment. So average decision break-even in the Permian has been observed at the level of approximately 42 USD per barrel in 2016 and 2017. But the main question now, are we really capturing everything on the cost side when we look at it this way? And if you just go to the next slide, the answer is, of course, no, because we had very massive investments into the facilities, or kind of surface facilities, infrastructure, water treatment systems. We also always have quite significant G&A overheads. And essentially, when a decision about marginal well is being taken, these costs are not really relevant, because you cannot really save on your G&A OPEX if you decide not to drill and complete each additional well. But when you just look at all these costs which were actually reported by the company and companies and distribute them across all historical wells which were completed recently, we're actually talking about a fairly significant uplift to this break-even prices, almost 20%. And some players are already moving to the right of 50 USD per barrel line. And this is, even this is not everything. So if you go to the next slide, last year we also had extremely high M&A activity prices, up to 60,000 USD per acre in the Permian Basin. And for a full cycle perspective, these prices are also relevant. So basically for the majority of the players in the Permian, they don't really generate very significant uplift to the break-even prices. But you can see that there are some late entrants for whom we're actually talking about 10 and even higher USD per barrel uplifts in the break-even prices. So if you sum all these cost components, you're actually talking about 53, 54 USD per barrel break-even on average in the Permian. So which means that from the full cycle perspective, average Permian well in 2016 still was not able to deliver 10% return. So if you go to the next slide, I think very important situation right now that what we saw in the previous chart, this situation is not really improving. It's actually moving in an opposite direction. So this year we have been gradually getting first signs and evidence of quite steep cost escalation in various service industry segments. And so one segment which is particularly transparent in our view is the proppant market. So there we have like 5 listed proppant suppliers who account for almost 50% of the market as of 2017. And if you just look at what kind of realized proppant prices they're getting, which are shown by this orange line, quarter by quarter, you can see this 50% growth from quarter 3 2016 to quarter 3 17. Of course, there are a lot of portfolio effects affecting realized prices. You know, back in 2014, contribution of ceramics and resin-coated proppants was much higher than in 2016, generating additional, somewhat misleading cost deflation in 2015-2016. And then also there was a very important shift in this industry. Back historically, this industry was really dominated by proppant supplier service provider relationships, while service providers were further delivering the proppant to the well site and normally charging some premium for that. In 2017, in this period of fairly steep cost escalation, we really observed that more and more E&Ps started going directly to the proppant suppliers, trying to lock in long-term proppant agreements. And this indeed generates some additional upward pressure on the typical realized prices from the proppant supplier perspective. So this cost escalation is a little bit exaggerated, but in general it still gives you an idea about overall trends. Realized proppant prices increased by approximately 50%. From E&P perspective, proppant cost per well increased by only 47% due to this shift to operator proppant supplier relationships, even though proppant loading is still increased. But still, I mean, it's quite clear that we moved outside of this very comfortable range of 0.5, 0.6 million USD of proppant cost per well, and these costs are really trending upwards already now in 2017. And if you go to the next slide, when it comes to the total drill and completion cost per well, I think the industry is still really dominated by old, cheap service contracts, particularly on the drilling side, but to some extent also on the pressure pumping side. So now in 2017, there is some sort of disconnect between the communication, between the steep improvements in the margins of the pressure pumpers, for example, and drill and completion cost per well, which E&Ps are reporting. So there is really, we are really talking about quite significant lag until the moment when new, more expensive service contracts become visible on overall drill and completion cost per well picture. So, but still, as of Q3 2017, we actually observed that drill and completion costs per well in both Midland and Delaware increased by approximately 16-21% year over year. Yes, wells still became a little bit more intensive compared to what they were back in Q3 2016. So if you normalize it per 8,000 feet in Midland and per 6,000 feet in Delaware, we are still talking about 10% cost inflation year over year. And more cost inflation will come in 2018 as old cheap contracts gradually expire. So if you go to the next slide, then we can also address this from the wellhead break-even prices perspective, because costs are growing, but wells are still getting more productive in many acreage positions. But on the break-even price side, which is sort of a net impact of the changes in the costs and changes in the well productivity, we also observe some degradation in the well performance. And it has been a fairly consistent degradation for median well in the Permian Basin since Q4 2016. So as of today, operators are observing $5 per barrel higher break-even prices on average than back in Q3 2016. And it's not really a portfolio effect, because the break-even prices in Tier 1 are also trending upwards quite significantly in recent quarters. And in fact, activity is really dominated by Tier 1 in the Permian Basin. As you can see, that median is extremely close in recent quarters to Tier 1 break-evens. So as we move towards 2018, this, the break-even price, it's very important to understand that the break-even price is always a function of oil price environment. So in a price environment of 50 to 55 USD per barrel WTI next year, if we just assume this kind of price environment, we observe a set of different factors which affect break-even prices in different directions in a very complex manner. So first, we'll still observe some optimization of the well design, optimal lateral lengths, optimal completion intensity, some other things affecting break-even price in a positive direction. Then, particularly on the Delaware side, we observe more and more operators gradually shifting towards the development phase of activity. Then we'll definitely observe quite steep increase in the in-basin proppant penetration in Texas from all these sand mines which are coming online already now, and more will come in 2018. This will basically eliminate the need to cover transportation costs between Wisconsin and Texas for the northern whites. So this is kind of a part of the cost which will be eliminated from the supply chain completely in some areas. And finally, we will observe more and more E&Ps gradually moving to go into the proppant suppliers, trying to integrate water treatment services and also the chemicals, and in some cases pressure pumping. But on the other hand, we'll have some factors which will affect the break-even price in the opposite direction. So old cheap service contracts will keep expiring. There will still be observed some moderate cost escalation for new service contracts. We'll observe more bottlenecks on the logistics in general within the supply chain. Basically, it's about the traffic which we now observe in Midland and Delaware. And finally, we'll have some new entrants in the activity with activity in the non-core areas, which will push average in a negative direction. So basically, net impact of all these factors is currently expected, as you can see on the chart, is that we'll still have break-even prices trending upwards, but it won't really prevent quite significant activity expansion next year. So what do all these things mean on the production side? If you go to the next slide. First of all, it is about base decline, which have already been discussed quite a bit today. So Permian, of course, illustrated quite significant growth in 2015-2017, but this growth came at the cost of quite significant acceleration in the pace at which production falls if we don't complete new wells. So essentially, we just went from 0.5 million barrels a day first-year base decline regime to 1 million barrels a day first-year base decline regime. And in the next 3 years, we will need to offset 1.6 million barrels a day of the base decline with new activity, new volumes in order just to keep production flat. And what kind of volumes can we basically get in different price environments? So if you go to the next slide, First of all, let's just imagine that WTI price suddenly collapses to mid-30s, just hypothetical scenario. And in this scenario, I think it's quite interesting that we will still have a lot of inertial growth. Major part of the ducts will be completed. Some additional delays will be observed. Rig counts will start trending downwards quite quickly, but at least in the first half of 2018, Permian Basin production will still be able to grow and reach 2.9 million barrels a day around mid-2018. After that, activity will fall to such extent that it won't be able to maintain flat production, and production will start falling. But still, we shouldn't really expect the base production will become more mature relatively quickly, and we shouldn't really expect that production will collapse completely, because even in 35 USD per barrel environment, where we actually observe a new wave of cost deflation towards 2020 and even faster convergence of activity towards development type of well configurations in the core acreage positions, activity in these acreage positions will still be sufficient to offset the base decline from 2020. So essentially we think that Permian Basin oil production will stabilize around 2.6 million barrels a day by the end of decade. So if you go to the next slide, if we talk about a little bit more realistic price scenarios, really large sensitivity is triggered when we move from 35 to 45 USD per barrel environments. So this is kind of an inflection point for the Permian Basin, which is really sufficient to maintain significant activity at more or less the current levels. It's 45 USD per barrel. So this is kind of the minimum that is needed for the Permian Basin to maintain a moderate pace of growth additions towards 2020. But as we move from 45 to 55, we're talking about additional growth potential, and in this scenario, Permian Basin is expected to reach 3.2 million barrels a day by the end of 2018 and 3.9 by the end of 2020. Finally, if you go to the next slide, really large additional sensitivity is triggered when we move from 55 to 65 USD per barrel price environment. 65 is really a price environment which is needed to trigger new activity in the non-core parts of the Permian Basin, and also in some parts which were normally considered as core, but activity has really disappeared in these areas because some other acreage positions were actually prioritized. So in this scenario, we're getting a lot of additional volumes versus 55 USD per barrel, but when we move from 65 to 75, additional potential is actually limited in the medium term, because this is where we actually start running into the bottlenecks on the service industry side, in some cases pipeline takeaway capacity, and in general proppant logistics situation and traffic situation in the Permian Basin. So just to sum it up, I would say that we see 4.5 million barrels a day as a maximum production potential around year-end 2020. But in general, it is quite clear that in the current price environment, despite some acceleration in the decline rates for new, very intensive, high-density wells, the current activity level is just way above the balancing point, the number of wells which is needed to maintain flat production profile. And so it's quite clear that at the current activity level, Permian Basin production will keep growing, and this growth will basically extend into the next decade. So with that, I think I conclude my presentation, so I pass it back to John.
Thank you very much, Artem. So now I'm going to ask my colleague Lynn Westfall to help ask some of the questions, many questions that came in through the chat option.
All right. Thank you, everybody. I'm Lynn Westfall here at EIA. I serve as the Director of the Office of Energy Markets and Financial Analysis, and I was volunteered to lead this panel discussion, but I'm glad to do. But I'm going to have to start off with an apology in that with the time constraints we have, we will not be able to get to all of your questions. I apologize to the people in the audience if we can't get to your question, but I'm trying to group them together in larger groups because a lot of the questions are geared along the same thing. All right, first question I think deals with the WTI Brent differential, and the question is, are there factors other than U.S. production affecting this differential, the widening that Harold put out in his presentation, and what would you see as a more normal differential going forward, and when might we expect to get to that level? Artem, you want to take it first?
Switch back.
Yes, I think I can do it. Yeah, so I would just basically briefly comment that, of course, after the Harvey storm and also when exports basically jumped in the U.S., the differentials which we have been observing in recent weeks is not something that is sustainable in our view. So essentially, as we move towards 2018 and 2019 and some of the remaining, some of the refining capacity which have remained shut in recent weeks, as soon as that basically comes back, I'm talking about the domestic U.S. Refining capacity. We think that the spread will converge a little bit, but it won't be as low as it was during the major part of the downturn. So essentially, we're talking about $3-4 USD per barrel spreads in the medium term. So this is our current projection.
Philip, anything you want to add?
Yeah, I mean, we are seeing the same exact thing in the thought that, that the convergence will occur, especially, as the capacity comes online, inside of recent months. Then also, I mean, it's been pretty constant over the last year or so, and again, there's always fluctuations, but it always needs to come back down to the same levels.
So you think those same levels can sustain increased U.S. exports of crude? I mean, if we start going to markets further and farther away with our exports, will that differential have to widen over time?
It probably will, yes. Again, it's hard to, forward think, exactly on those. I mean, it will at some point. The financial markets don't always work in the same way that your normal theory would. So eventually it would have to. It's just a question of whether or not how long it takes the market to get to that point.
Harold, John, anything you want to add?
I just say we had a Today in Energy article about this topic yesterday, so if people are looking for more material, there is more material online.
Harold?
Yes, well, I might just take us back a few years back. Historically, we were superior to Brent prices by $2 a barrel, and that changed, as the discount occurred due to the refining shortage here in America. We went the other way, and we should see it normalize back. But this blowout to $7 really just goes back to the past 6 months when you look at the chart here. So it's a very short term. Does it have to do with constraints in bottlenecks at Cushing and other places? Sure, all those things figure in as well. But basically, what is disadvantaging Cushing market? And certainly, when you have a perceived glut of oil on the market, that's one of the biggest drivers. And so we see that as being the biggest part of this, $4 to $5 a barrel.
Okay, thank you. And while we have you, Harold, here's a question for you. Philip's presentation talked about the shortage of completion crews. Are you seeing this in your company? Is it serious? Is it a long-term problem? And kind of what are you doing about the shortage of good completion crews?
It differs by basin, so you almost need to get into each basin. West Texas is particularly hit hard. Let's just go out there and take some examples. Culberson County, very big county, big as Delaware. That entire county has 90 people in it. They've got a big problem right now because the sand companies are paying more for truck drivers than the crude oil companies are paying to haul oil. And so a lot of operators having to shut the wells in because their tanks are full. So, I mean, those type of problems have come up. Tim Dove at Pioneer, I think said it right. He and I were on a panel recently. He said, the biggest competition we have is the apartments being built in Dallas. We lost a lot of workers. They went into the construction business, and that's where they are today. They've got permanent, steady jobs, and they're not coming back. So those are some of the problems out there because of the scarcity with people.
Great, thank you very much. Artem, there's a question for you. Your presentation, you showed a wide range of break-even prices in the Permian Basin for the 30 companies you followed. What's the major cause for the big spread in break-even? Is that unique to Permian? Is it other places? Is it geology? Or why is there such a widespread break-even price there?
Yes, sure. Basically, I can comment on this. So, first of all, I think what we have generally observed during the last 3-4 years in the Permian, that once activity was really shifting towards the development phase for operators, it was always about, eventually about the acreage quality, the source rock quality. That was the only driver of discrepancy in the break-evens in most cases. Of course, there are some interesting agreements with respect to royalty. Some operators who are landlords owners, they simply realize somewhat better break-evens due to the lack of royalties. So this could also be the driver. But in general, in the Permian, we have actually quite strong variability in the acreage quality. It's as probably Phillip said during his presentation. So there is no two places are not exactly never the same. So we have so many landing zones, and even within the same landing zones, we have a lot of tier 1 locations. We have tier 2, tier 3, tier 4. So it's not the same in terms of the quality. And finally, the Permian, again, particularly on Delaware side, a lot of operators, they still remain in very early test type of activity with short laterals, either due to the lease structure constraints or due to the fact that they still need to move the rigs quickly from one pad to another in order to hold the entire acreage by production. So there is still a lot of unlocked potential in the Delaware, and we will see a lot of structural improvements in the next 2-3 years, and some of these improvements will result into new efficiency and productivity gains and have an opportunity basically to offset some of the cost escalations which we are most likely getting in 2018-2020.
Great, thank you. Phillip, for you, you showed a lot of charts on the decline curves in the Permian with 14, 15, and 16 data. Have you seen anything for 2017 that would lead you to believe that that initial production rate is still going even higher, but maybe with more decline? Have you seen any data for 2017?
Yeah, so the initial data is actually showing the IPs are coming on higher. Now, again, this is in areas that we are not yet downspacing, probably closer than 120 acres. So, 4 wells per section. So as long as we're maintaining that, we are seeing IPs go higher. And we're definitely seeing decline rates stay the same. Now, again, a lot of the newer activity we've been seeing has been pushed out to the shallower regions of the Delaware. So the shallower regions have a lot higher GOR, and so again, sometimes those IP rates can be skewed, especially on the 6-to-1 instead of on a 20-to-1, just because of that gas. Now, on the Midland side, we've definitely been seeing it for very, very similar reasons, other than we're not seeing a huge gas increase, but we are seeing longer laterals being actually used. And again, they're targeting specific zones right now, whether that's for returns, whatever else, that are pushing production going up. Now, we are seeing operators that are downspacing a lot closer to the 120 acres. We are starting to see those wells, in a sense, normalize out, which is okay. Again, it's dependent on whether or not you're trying to, basically do what the engineering side of me says to do, which is have the highest recoveries actually you can inside your DSU, compared to an intention of maybe having a higher return. So again, we're starting to see some of that stuff come up because there really hasn't been that many wells that have been line racked. We're still trying to figure out what the optimal spacing is, especially not only on the horizontal but on the basically the tangential component of multi-stack laterals. So there's a number of factors that are going to affect, especially as we start to get into that full production mode. But at least for new wells in 2017, we are still seeing a double-digit increase in terms of both rates, and then decline rates are kind of staying the same.
Great, thank you very much. I know we're running a little bit over time, but I'd like to end up here with asking each participant, other than John, over the next 12 months, what do you see as being the biggest challenge to increasing crude production? And if you could gear your answer towards what things EIA needs to pay more attention to capture those challenges going forward. Because as John said at the very beginning of this conference, the purpose is to improve our modeling and to get information from you. So we'd very much like your ideas on what are the challenges and what things do we need to look at to improve our abilities. So Harold, I'll start with you.
Well, I mentioned several things in there, and the last presenter talked a little bit about maximizing production in drill and spacing units, and if we have in your model that every well is going to be 20% bigger this year, I mean, that needs to be moderated. That probably led more people astray in our industry this year than ever before. And more pad drillings. We're going to see increased drill but uncompleted wells because it slows down the process when it's much faster to drill all those wells from a pad than it is mobilization and all those things. But as an end result, you have a lot more capital invested, you have a lot more wells drilled but uncompleted. That result, that doesn't necessarily come in to mean more production. So that needs to be moderated, and certainly the parent-child well model that you have needs to be changed to get it right.
Great. Thank you for your insights, Harold. Phillip, your thoughts?
And I'll agree with Mr. Hamm that, the biggest issue is generally understanding what is on a pad, what is pad drilling. So again, the tighter the spacing of the wells, how are those wells different from your, single section wells? Huge thing to take into account that I think a lot of times we definitely forget about, as we go forward. And then also the understanding of, possible, constraints both on the midstream side and on the refining side, in the sense that, basically a lot of the stuff that's coming out of the Permian is a lot higher crude quality. We always have to blend at a certain point, and so trying to understand kind of the macro impacts of just other things that are going on in the world in order to, get that crude in order to blend to make it worthwhile to refine at a good pricing environment. So, again, trying to take not only the overall DSU into consideration, but also some of those midstream and downstream effects that are pretty important. Once we actually get it out of the ground.
Great, thank you, Phillip. Artem?
Yes, I guess, in the next 12 months, the largest challenge for the U.S. oil production will generally be, this fight between the additional efficiency gains and service cost escalation, and also all kind of supply chain bottlenecks, which I was talking about. When E&Ps come out with guidance for 2018 in a couple of months, I think if we just put some of these guidances bottom up, we might arrive to much more optimistic production growth for the U.S. oil compared to what you currently have in your STO. But then it will be really important to address whether it's actually realistic from the service industry perspective to deliver on every single operator's production growth. So that will be very important. But I would also like to comment on the historical U.S. oil production a little bit, because it is true that U.S. oil production surprised a little bit on the negative side. Many market participants in 2017, it was really underperforming. But August production, even though it came at 9.2 in both EIA 914 survey, and also this is supported by all the data from state agencies, the actual production potential was already sitting at 9.5. So it was really affected by the Harvey storm, because we had Alaska in the middle of maintenance season. We had Goom also producing 70,000 barrels a day less, as it was affected by Harvey, and we had Texas affected negatively by 110,000 barrels a day instead of growth of 50,000 barrels a day, which was implied by the completion activity. So as we're now looking at the preliminary production data for September, and I think you on your side might see the same kind of, get the same impression from EIA 914 survey, we're actually talking about a very significant jump, as most of these volumes will come back. Some of them will again disappear in October due to the NATES, but we're actually talking about at least 250 to 300,000 barrels a day monthly addition from August to September. So we'll be at least around 9.5, and there is an upside potential to this figure. So in light of this, we actually think that your current 9.7 projection for December 2017 might end up to be even a bit conservative if we don't get any winter shocks in North Dakota or also New Mexico and some other states. So the actual production potential will be actually trending towards 9.8 plus million barrels a day by the end of 2017.
Great, thank you very much. Well, on behalf of EIA, I want to thank particularly all the presenters here for the wonderful material. It accomplished our goal of getting insight that we don't always have, and your ideas of how we can improve our forecasting ability are greatly appreciated. I'm sure this is not the last of these that we'll be having. They will be making this more of a routine thing with all the changes in the environment going on. And I want to thank everyone who dialed in to participate. Sorry we couldn't get to all your questions. There will be a posting of all the slides as well as a transcript of the discussion on our website. So thank you very much and have a good afternoon.
Thank you, everyone.
Thank you.